You've got $10,000 just sitting in your bank account or hard cash. It's tempting to leave it there, right? It's safe, it's easy, and it's, well, doing absolutely nothing for you. Now, what if I told you that by investing that money, you could make it work for you and potentially grow it into a much larger sum? Sounds pretty good, doesn't it? In today's video, I'm going to show you the 5 best assets you can invest your $10,000 in right now. I will show you each option, breaking down the pros and cons, and I'll even give you some real-life examples of how much you could potentially earn from $10,000. Alright, let's tackle a big question. Why shouldn't you just keep your $10,000 in cash or in the bank? I mean, it's safe, right? And there's no risk of a bad investment wiping it out. But here's the thing. While it may seem safe, keeping your money in a cash or a basic savings account is actually one of the least effective ways to manage your finances. Let's break down why. One of the biggest enemies of cash savings is inflation. Inflation is the gradual increase in prices over time, which means that the same amount of money will buy you less in the future than it does today. For example, if the annual inflation rate is 3%, $10,000 today will only have the purchasing power of about $9,700 next year. Over time, this can significantly erode the value of your savings. While banks do offer interest on savings accounts, the rates are typically very low. In many cases, the interest you earn is less than the rate of inflation. For instance, if your savings accounts offer a 0.5% annual interest rate and inflation is 3%, you're effectively losing 2.5% of your money's value each year. That's not a good deal. Every dollar that sits idle in a bank account is a dollar that could be working for you. By not investing, you're missing out on potential gains that you could achieve through various investment options. The opportunity cost of not investing is the return you could have earned. Over time, this can add up to a significant amount. If you have financial goals such as buying a house, funding education, or planning for retirement, simply saving cash won't get you there as effectively as investing will. Investments can help you reach these goals faster by providing higher returns. For retirement in particular, investing is crucial to ensure that you have enough money to live comfortably in your later years. Coming up next are the 5 alternative asset options to keeping money in cash or bank, ranked by their potential to pay more than the previous asset. Alright, let's start with our 5th asset, bonds, which are often viewed as a more stable and predictable investment compared to other investment alternatives. Bonds are essentially loans that you give to corporations or governments in exchange for periodic interest payments and the return of the principal amount when the bond matures. Investing in bonds comes with several advantages. Firstly, bonds tend to be less volatile than stocks, making them a safer option for risk-averse investors. They provide regular interest payments, which can be a reliable source of income. For instance, if you invest $10,000 in a bond with a 5% annual yield, you can expect to receive $500 per year in interest. This is significantly more than what you could earn from a typical savings account, which might only offer a 0.5% interest rate, yielding just about $50 annually on the same amount. There are different types of bonds you can invest in, such as government bonds, corporate bonds, and municipal bonds. Each type has its own risk and return profile. Government bonds, like the U.S. Treasury bond, are among the safest investments because they are backed by the full faith and credit of the U.S. government. Corporate bonds, issued by companies, typically offer higher yields but come with higher risk. Municipal bonds, issued by state and local governments, often provide tax-free interest income, which can be a significant advantage depending on your tax situation. Now, let's consider the potential earnings from a $10,000 investment in bonds. Assuming you invest in a mix of government and corporate bonds with an average annual yield of 4%, your $10,000 investment would grow to about $14,802 over 10 years. This includes the reinvestment of interest payments, which allows your investment to compound over time. While this return is more modest compared to stocks or real estate, it is significantly better than leaving your money in a bank account. Comparing bonds to keeping your money in cash or a savings account, the difference is substantial. With the same $10,000 in a savings account earning 0.5% interest, you would have approximately $10,511 after 10 years. This barely keeps pace with inflation. In fact, inflation is around 3%, which means you're not even covering that, and you will be losing purchasing power of $2,927. Moving on to our next asset, that is number 4, mutual funds. These are other excellent options for diversifying your investments. Mutual funds pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. This makes them an accessible and efficient way to invest in a wide range of assets without having to pick individual investments for yourself. Investing in mutual funds comes with several benefits. One of the primary advantages is diversification. By investing in a mutual fund, you gain exposure to a broad array of assets, which helps to spread risk. For instance, if one stock in the fund performs poorly, it may be offset by better performance from other assets. This diversification is difficult to achieve when you invest in individual stocks or bonds on your own, especially with a limited amount like $10,000. Additionally, mutual funds are managed by professional fund managers who make investment decisions on behalf of the investors. This professional management can be particularly beneficial if you're not experienced in investing or if you prefer a hands-off approach. These managers use their expertise to select investments that align with the fund's goals, whether it's growth, income, or a balanced approach. There are various types of mutual funds to choose from, such as equity funds, bond funds, and balanced funds. Each type has its own risk and return profile. Equity funds invest primarily in stocks and aim for higher returns, albeit with higher risk. Bond funds invest in bonds and typically offer more stable returns. Balanced funds mix stocks and bonds to provide a blend of growth and income. Now, let's consider the potential earnings from a $10,000 investment in mutual funds. Suppose you invest in a balanced mutual fund that aims for an average annual return of 6%, outpacing inflation by 3%. Over 10 years, your $10,000 could grow to approximately $17,908. This growth is achieved through a combination of capital gains, dividends, and interest, all reinvested to compound over time. Next, and probably the most risk-free option on my list, is gold and precious metals, which have been cherished as valuable assets for centuries. Gold, silver, platinum, and palladium are not only sought after for their industrial uses, but also as investment assets that can provide a hedge against inflation and economic uncertainty. Investing in precious metals can be a smart way to diversify your portfolio and protect your wealth. Investing in gold and precious metals comes with several advantages. One of the main benefits is their ability to act as a hedge against inflation. Unlike paper currency, which can lose value due to inflation, precious metals tend to maintain their value over time. This makes them a reliable store of value, especially during periods of economic instability. For example, when inflation rises, the value of gold often increases, preserving the purchasing power of your investment. There are several ways to invest in gold and precious metals with $10,000. One straightforward method is to purchase physical gold or silver bullion. This can be in the form of bars or coins. Physical metals can be stored securely in a home safe or a bank safety deposit box. While holding physical metals gives you direct ownership, it also requires safe storage and insurance, which can add to the costs. Alternatively, you can invest in precious metals through financial instruments such as exchange-traded funds, or ETFs, and mutual funds. These funds invest in physical metals or in companies that mine and produce precious metals. For instance, a gold ETF tracks the price of gold and provides a convenient way to gain exposure to gold without the need to store it physically. This method is cost-effective and provides liquidity, as you can buy and sell shares of the ETF on the stock exchange. Let's consider the potential returns from a $10,000 investment in gold. Historically, gold has provided an average annual return of around 6 to 7% over the long term. Suppose you invest $10,000 in gold, and it appreciates at an average rate of 7% per year. After 10 years, your investment could grow to approximately $19,672. While this is a conservative estimate compared to more volatile assets coming up next, it highlights gold's role as a steady and reliable investment. Next on my list is real estate, which has long been considered one of the most reliable and rewarding investment options. While $10,000 may not be enough to purchase an entire property, there are still several ways to invest in real estate with this amount and reap the benefits of this asset class. One effective way to invest $10,000 in real estate is through real estate investment trusts, or REITs. REITs allow you to invest in real estate without the need to buy, manage, or finance any properties yourself. They pool money from many investors to purchase and manage a portfolio of properties, which can include commercial buildings, apartment complexes, and other real estate assets. By investing in REITs, you can earn dividends from the rental income generated by these properties, and potentially benefit from property value appreciation. Another option is real estate crowdfunding platforms, which have become increasingly popular in recent years. These platforms allow individual investors to pool their money together to invest in specific real estate projects. With $10,000, you can participate in these projects and own a share of the returns generated from rental income or property sales. Crowdfunding platforms often offer opportunities to invest in a diverse range of properties, from residential to commercial real estate, giving you the chance to diversify your investment within the real estate sector. For those interested in a more hands-on approach, house hacking is another strategy. House hacking involves purchasing a multifamily property, such as a duplex or triplex, and living in one unit while renting out the others. The rental income can help cover your mortgage payments and other expenses. While $10,000 may not be sufficient for a down payment on a multifamily property in many markets, it can be combined with other financing options such as FHA loans, which allow for lower down payments. This strategy not only provides you with a place to live, but also generates rental income to offset your living expenses. Let's explain these options with some examples. Number 1. REITs. Suppose you invest $10,000 in a diversified REIT that focuses on commercial properties. If the REIT offers an annual dividend yield of 5%, you would earn $500 per year in dividends. Additionally, if the properties in the REIT appreciate in value, you could see further growth in your investment over time. Number 2. Real estate crowdfunding. Imagine you invest $10,000 in a real estate crowdfunding platform that funds the development of a residential apartment complex. If the project yields an annual return of 8% through rental income of 5% and a property appreciation of 3%, your investment could grow to approximately $21,589 over 10 years, similar to the potential returns from other investment assets. Number 3. House hacking. Consider purchasing a triplex with an FHA loan, requiring a 3.5% down payment on a $300,000 property. Your $10,000 could cover the down payment and some closing costs. By living in one unit and renting out the other two, you could generate rental income that covers most or all of your mortgage payments, effectively reducing your living expenses and potentially building equity in the property. And now at number 1, and one of my favorites, is the stock market. Investing in stocks can be a powerful way to grow your wealth over time, and it's one of the most accessible investment options out there. But what makes the stock market such a great place to put your $10,000? Let's break it down. First off, the stock market offers the potential for significant returns. Historically, the stock market has provided an average annual return of around 7 to 10%, and that is after adjusting for inflation. This means that over the long term, your investment can grow substantially. Stocks represent ownership in a company, so when you buy shares, you're essentially buying a piece of that company's future profits. Compared to keeping your money in cash or a basic savings account where it essentially loses value over time due to inflation, the stock market offers a chance for your money to work for you. Stocks also provide liquidity. Unlike real estate or certain other investments, you can buy and sell stocks relatively quickly and easily. This makes the stock market a flexible option for investors who might need to access their money sooner rather than later. In contrast, if you keep your money in the bank, it remains stagnant, earning minimal interest that often doesn't keep up with inflation. When it comes to the types of stock investments you can make, you have a few options. You can invest in individual stocks like shares of Apple, Amazon, or Tesla. These companies have shown impressive growth over the years, and investing in such well-known companies can be a great way to start. Alternatively, you can invest in exchange-traded funds, or ETFs. ETFs are collections of stocks that track a specific index, like the S&P 500. Investing in ETFs can be less risky than investing in individual stocks because they spread your investment across many different companies. This diversification helps mitigate the risk of any single company's poor performance dragging down your overall returns. Again, this is a far more dynamic and potentially rewarding approach than letting your money sit in a low-interest savings account. While the stock market offers great potential for returns, it also comes with some relatively higher risks than our previous options. Stock prices can be volatile, and there's always the possibility of losing money. That's why it's essential to do your due diligence before investing. Understand the companies you're investing in and keep an eye on market trends. This level of involvement and understanding is what can make the difference between seeing your money grow and simply watching it erode in a savings account. Let's get to the exciting part. How much can your $10,000 grow if you invest it in the stock market? Assuming an average annual return of 10%, your $10,000 could grow to approximately $25,937 in 10 years. As an added bonus, most stocks also pay dividends. Let's say they pay 2% in annual dividends. Assuming the same $10,000 investment, with reinvesting dividends, your $10,000 in the stock market after 10 years is expected to reach $29,176. Want to know how to turn a $25 per week investment into a portfolio that pays over $5,000 a month? Click the video on the screen to find out.